Today on the final bar, we'll talk about a market on a bit of a digestion day, continuing to get a bit of follow through to the downside, but technology actually recovering after yesterday's bloodbath of distribution. You know, this week, when you summarize the week, which is what we like to do on a Friday show, it's certainly distribution. This is the first week I think we've really seen some follow through to the downside, but a lot of levels still yet to be crossed. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a somewhat snowy, sleety Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity, the markets, focus on the message of the markets themselves as indicated by the charts. Technical analysis, visual analysis is based on understanding price trends and analyzing investor behavior through the charts, focusing on where the trends are, following those trends, but then number three, anticipating when those trends may be exhausted. And as I'm looking at the markets this week and talking to some of my peers and mentors in the industry for our Behind the Charts season 2 coming very soon, I'm reminded of the importance of focusing on the charts, focusing on the trends, and seeing how the trends are playing out, having clear lines in the sand, clear levels at which you agree to review and reflect on particular positions. And that is what hopefully we're able to do together today. We have some great guests. This week was fantastic. We had Cliff Droke on the show yesterday, Keith Fitzgerald on Tuesday. Some really good conversations thinking about inflationary conditions, growth versus value, this rotation into sort of the, away from some of the new energy back into the old energy. More of the same coming next week. On Tuesday, the 2nd, we have Jonathan Krinsky from Baycrest Partners. On Wednesday, the 3rd, Jeff Huge from JWH Investments. And then on Thursday, Ari Wald, technical analyst at Oppenheimer. These are 3 analysts that much of the street pays attention to. That's their go-to technical analysts. So it should be a lot of fun having them on our show. Also, just a quick to point out, on Monday, this coming Monday, the 1st, I'll be joining Erin Swenlin in her Decision Point Live trading room. Go to decisionpoint.com to register for that free event. Also, we are in the process of recording Behind the Charts Season 2, which should be coming your way very, very shortly as well. Let's start with our weekly wrap segment. We're going to start focusing on a poll question. We asked all of you, how important is sentiment? Things like the AAII survey, the name exposure index. We usually talk about those on our Thursday show because that's when a lot of the weekly data is updated. How important is sentiment in your process? The most common response, somewhat important, 36%, followed by not very important, 27%. 19% of you say you never look at these things, and 19% of you said very important. That's about what I would expect. I'd expect people to be sort of medium, lukewarm about these. To be honest with you, I have always found, I'm thinking of conversations I've had recently with like Mark Young from Wall Street Sentiment, Jason Geffert from Sentiment Trader, and they have made a successful career out of focusing on market investor emotion as reflected in the weekly sentiment readings. They do a fantastic job of it, and I've always remembered how important it is to have that check-in. For me, as I've always told you, it is not the number one thing I pay attention to, but it is a crucial part of that toolkit. It starts with price and then breadth and then sentiment. Price is king. Price is most important. Breadth qualifies that movement in price by telling you about participation, but sentiment is a really important way to see how people are actually understanding the market environment. And when the market moves and sentiment disagrees, or when sentiment is at extremes, which is when arguably those indicators are most effective, that's when there can be a real message there. And we're coming out of this scenario here, excuse me, in the first month or two of 2021, when sentiment has certainly been at extreme levels. And so I think it's worth paying attention to some of those indicators if you've not done so in quite a while. We'll do a quick recap of some of the key charts. We'll look at the weekly trends and how they evolved, and then we'll go to our Mindful Investor Live chart list to focus our time and think about how the week, how things have unfolded week to week. The S&P really choppied around for much of the day, finished down about 0.5%. Mid caps and small caps actually finished in the red as well, even though they were positive for much of the day. The Nasdaq, probably the big outlier, up about 0.6% for the Nasdaq 100, and the VIX back down just above 27. Bonds back moving up. Apparently, I'm now learning that bond prices can go higher, and we saw that today with the TLT up 3 1/3%. 10-year yields back down below 1.5%. But again, certainly, at elevated levels relative to what they've been historically. Commodities really took it on the chin today with gold and silver, precious metals, also base metals like copper moving down materially through the course of the day. Energy was the weakest of the 11 S&P sectors. As well. Cryptocurrencies essentially flat to down. These are relatively low percent changes on an asset class that has been known for volatility, and rightly so. Not so bad today. I did want to focus here on the wrap the week. I didn't get a chance to update these labels, so forgive me for that. I'll do my best to point out where things are at and talk you through some of the indicators. The S&P 500 is here in black. Finished the week down 2.5%. If we go to the, let's see, what underperformed the S&P, gold had actually been doing okay, but actually finished negative because it sold off a little more today as well as yesterday's session, finishing down about 3%. In purple, we have small cap stocks down 3 1/3%. Far underperforming, we had the NASDAQ down 5% for the week. And here in orange, we have emerging markets down 6.6% for the week. What outperformed the S&P 500 this week? Well, with the rally in bonds today, bonds actually finished flat for the week, which will improve over the S&P's returns for the last 5 days. The dollar was actually up 0.7%. It's interesting that rotation from a weaker dollar environment to a stronger dollar environment would certainly be a different feel than what we've seen here for many, many moons. But again, still early days in there. I think there's a lot to be proven before we can say the dollar is in any sort of constructive price pattern overall. Most recently, it was a breakdown of a key trendline support, but up 0.7% this week. The big winner was crude oil, which still, with today's pullback, still finished 4% higher on the week. Now, when we add Bitcoin in the mix, usually it's an outlier. It was down here, down 17% for the week. Really, cryptocurrency is obviously pretty wild, but you've seen a sort of a risk-off feel to the chart of Bitcoin, really chopping around, testing that first key Fibonacci support level. And I think if we do break that second Fibonacci retracement level, around 42,000, if I remember right, I think would be the one to look at. Let's look at the chart here and see if I don't consider myself great at picking out levels out of a hat. I wasn't far off. 40,000. I thought that didn't sound right. 42,000 was the peak there from January. 40,000 here. It always frustrated me when I worked with Tom DeMark more closely. He would tell you particular turning points, inflection points on the Nikkei from like 1984 or some random turning point. And I can't remember Bitcoin from last month, but that is why I look at the charts, because the data is all there laid out for you. So there you go. Let's continue on. Just check in on the markets in the form of the Mindful Investor Live ChartList. If you've not seen one of the Friday shows before, this is all a chart list that you can access. If you go to your member dashboard and go to chart lists here on the, I'm sorry, actually that's not right. Click on articles here at the top. Go to my blog, which is called The Mindful Investor. And at the very top of that, you'll see this button that says Live Chart List. That's the way you can actually access this exact list of charts that we're going to review together. You're welcome to save them in your login, tweak them, adjust them, do whatever you want. Chart number one is the S&P market trend model. We review this pretty regularly, and it's updated every Friday. It's based on weekly data. So during the week, I'll check it out, but it's really about locking in the Friday close and identifying the long-term trends. It has 3 components: short-term, medium-term, and long-term. The short-term component essentially looks at where the close is versus the 5-week exponential moving average. This is the first time we've closed below it since the pullback in January. Before that, you had to go all the way back to last October. We actually closed below it this week, and it was interesting to see, today, see if we'd have a bounce to take us back above that level. We did not. So as of now, I'll rotate this to a short-term bearish signal. That's a tactical bearish trend on the S&P. The medium-term trend measure, which is here, it's basically just using the weekly MACD, or what we call the weekly PPO, the percent price oscillator, using the traditional settings that most would use. And on the weekly data, it's simply when we get a buy and sell signal, a crossing of these two indicators. We got a sell signal today. So locking in on the close, we have the short-term crossing down through the long-term. That's the first sell signal. It's been bullish since early November of last year. It turned negative sort of mid-October on the pullback there, and then turned positive a couple weeks later. We've now registered a sell signal. So the medium-term trend also bearish. The long-term trend, nowhere near bearish. This is really meant to capture more about the longer term trend, sort of the long cyclical read, even the secular read. And in general, this has been bullish since early June, and for the most part, for the last 10 years has been bullish. So we'd have to sell off and have quite a distribution before you get a sell signal from there. So in terms of the tactical read, the things that I tend to look at as a way of determining what I would do with new capital, the short term and especially the medium term are the two I would look at. The fact that we've gone to a medium term bearish signal, in my opinion, suggests you need to start to be a little more cautious and think more about the risk potential than the reward potential. Be looking at your positioning and thinking about what lines in the sand and making sure those are updated, because we have a heightened risk now of further distribution and breaking key levels of support. So that's kind of where we're at with the market trend model. The daily S&P chart here, I'd mentioned on social media earlier this week, the three-step process to validating a sell signal in terms of the S&P transitioning to a bearish phase, in my opinion, has three parts. Number one, you break your first trend line, which is this pink trend line here, which we broke back here in late January. We rebounded and then tested it from below and now have rolled over again. Step two is you break the 50-day moving average. You actually broke a second trend line, which I didn't include as one of those steps, but we did break a second trend line. You take the October low and the January low. We actually closed below that yesterday and validated, followed through with it today. We closed almost to the tick right at the 50-day moving average yet. So I don't think I can declare that a break of the 50-day. At this point, it's found the 50-day, much like it did at the end of January. So the decision point for next week, or the question that the market will have to answer for us, is this a late January pullback to the 50-day before a resumption of the uptrend and a push to new highs, or do we finally break the 50-day for the first time since back here September of October, which tells us to expect at the very least more of a consolidation phase, a multi-week, multi-month consolidation phase, or even something deeper. And again, there's a non-zero probability that we have a materially lower move from here, that we test 2,900 or 2,850 or even 2,200. I'm not saying that's a high probability, but it is a probability. And when we break support levels up here, that's when these levels seem a lot more reachable, right? A lot more possible. And all it does is to make me rethink, what are the probabilities of those things happening, and what would I do in some of those different scenarios? So step one, we have accomplished, which is a breakdown of the first trend line. Step two, a breakdown of the 50-day. I don't think we've seen that yet. And next week, we'll have to see if we follow through or not. And then step three, which I didn't mention, get below the January low, which would be around 3,700. If we follow step two and step three, you will hear me get a lot less constructive, a lot less optimistic about a recovery phase, and more thinking about how to circle the wagons and protect yourself, for an increased likelihood of a further downtrend. I've talked about, at the end of the year, my projection for 2021, which again is always something that's more instructional and less predictive in my experience. But overall, my guess was more of a 2010 type of move, which is a choppy year following the 2009 bottom and rally. And then we ended up finishing positive for the year, but there was a lot of movement along the way. And I think we're going to have a similar year to that. I would not be surprised if we retest 3,200 before we would regain new highs. That would be a totally reasonable 2021, in my opinion. We have a couple minutes left. Let's go through each one of these, just a quick check-in. Breadth measures are mixed, some of them giving bearish divergences, some of them not. And one that's not is the key one that I look at, which is the cumulative advanced decline lines. These all continue to make higher highs and higher lows until that trend changes. It tells you overall the trend in breadth is positive. One of the key tells I've found for distribution is what you saw January and February of 2020, which is the market going higher and these cumulative advanced decline lines sloping downwards. We're actually not seeing now. All four of those are continuing to be an uptrend. So that's actually not flashing a warning signal yet. Yesterday, I was talking with Carl Swenlin, who completely fixed an issue I had. I was trying to figure out why the new highs reading was so heavy yesterday. It was almost 15% of the S&P made a new high yesterday. But my screen for stocks making a new 52-week high was only 10 names, and that's because I was looking at closing data. How many stocks made a new closing high yesterday? Not many. 10 stocks out of 500. How many made an intraday high? It was 69 out of 500. Still 14% of the S&P made a new intraday high yesterday. So again, as much as this week felt distributive, and it certainly was in some ways, plenty of stocks making new highs. What is not making new highs is the percent of stocks above their 50-day, which is certainly an area of concern. That, combined with the euphoric sentiment, which we've covered, I think, ad nauseum this week, is certainly suggesting breadth conditions a little more negative. Sentiment remains elevated, but not euphoric. And I think one example of that is the name exposure index has come down this week from 105+% last week to 85%. That's down about 20 points. What that tells you is institutional money managers, large money managers, taking their foot off the accelerator a little bit. Just to finish off with some ratios, the cap weighted offense versus defense in consumer flat for the last month. The equal weighted, taking Amazon and Home Depot out of such an overweight of the numerator, makes this ratio go new highs. It still pays to own consumer discretionary over consumer staples. Staples are just not a good relative chart, and that's what that's telling you. Semiconductors continue to do well. We're going to look a little bit about this. I know there's a question on it in the mailbag that we'll answer, but I think this semiconductor group might be a really important one to look at as we go into next week. When you think about stocks that could be struggling, a bellwether group that doing well tends to make me feel good about the market, pulling back in the last week or two. And I think seeing if this can recover and return to new price and relative highs would be a very good argument for the bull case. That is our review for this week. If we didn't get a chance to touch on a lot of the ratios, but my show on Wednesday was a special episode focusing on ratio analysis. Check that out if you missed it. You'll fill in some of the gaps from the list today. Let's take a quick break. We'll be back opening the final bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. It's so good to have you join us every weekday after the close for our show as we review the action in the markets using the power of stock charts. As a reminder, we love to hear from you. We're going to open the mailbag here in a moment. These are all questions we've gotten from you in the last day or two. We'd love to hear from you and answer one of your questions in our next mailbag on Tuesday of next week. Shoot us an email, thefinalbar@stockcharts.com. On Twitter, just tag us in a comment at FinalBarSCTV. On our YouTube channel, put a comment right below the video that you're watching. We'd love to hear from you and answer one of your questions in our next segment. Also want to remind you, our new StockCharts TV app and website is live and ready for you to consume all of the StockChart TV goodness. My show, all the other shows that we have, all the great hosts, content, educational content, market commentary is all there on demand on all of your devices. Go to StockChartsTV.com. Go to any of the app stores, search for StockCharts TV. You can set up a free account with your email and check out all the videos. It's really, really well done. I'm super proud of the team and all of our fellow hosts for what they've been able to do so far. Let's open up the Final Bar mailbag. Again, no questions are out of bounds, and I'll do my best to answer what you ask. Question number one, guest time is very short, and you're absolutely right. I was thinking about that with some of my guests, Keith and who else do we have this week? We had Cliff on yesterday, and with some of them, honestly, that could be a multi-hour discussion. And some of my favorite experiences over my career have been long, deep discussions with some of those people. So well received, and we'll do what I can to get the guests on with longer time frames when we can do it. On a different note, there's a worldwide shortage of semiconductors for auto and smartphone industry. Forbes did an article on this a couple of days back. Weakness in semiconductors looks like a good opportunity. What are your thoughts? Yeah, I totally get it. And here's the thing. I think there is an argument for why semiconductors should do really well. And I get the argument. And I've told you, this group overall, if you look at the relative strength, it continued. Last 2 years, the relative strength has gone up and to the right. And what that means for me, we've had up phases and down phases during those last 2 years. And this is good offense and good defense. That's a good group to want to own overall. It's a core position, something that does well and outperforms in bull market phases and outperforms in bear market phases. So I get that. And I get the justification for why semiconductors should continue to do well for many, many years from now. What concerns me, though, is when we get to the point when it's no longer an actionable good idea today. And that's what I'm concerned on with the chart of something like the SOX or the SMH. It's bounced pretty, a little bit today, up 2%. NVIDIA came out with earnings yesterday or Wednesday, if I remember right. I think, again, as I mentioned, I think this is the world's most perfect bearish divergence. It is a textbook example of that. And my technical toolkit, my experiences tells me you sell that sort of chart expecting the price to go down, but you wait for it to get validated. So you wait for the price to break the 50-day and break the January low. That's what I'm seeing on the S&P 500. That's why we keep talking about those levels. That's what I'm seeing on the SMH. So it has fulfilled that third requirement for me, which is anticipate when the trend is over. I think we're getting signals of a rollover in semiconductors. Now it's about the price actually doing it. It's not followed through just yet. I think next week we'll see what happens. Question 2, biotech stocks seem to move more in line with tech than with healthcare. Is there a tech ETF that includes some biotech names, or am I just thinking of the Qs? It's a really good question. I think you've hit on one of the challenges of a group like biotechnology. When you think about the S&P and the equity universe being broken into 11 S&P sectors, there are certain groups that don't really fit anywhere. And examples would be biotech, right? It's sort of a mix. It's a hybrid of healthcare and technology. Things like media stocks, Disney, right? Think of all the different businesses Disney has. Where do you put that? So media is in that group as well. Internet stocks, for the longest time, are they tech, consumer, communications? And now the group is kind of split between three sectors. If you look at the FANG stock, arguably they could be their own sector of just these unique mega consumer tech communications stocks. Solar stocks are a similar one. Where do you really put those? So I think any sector, breakdown that I've ever seen, including ones we've tried to design from the ground up, they're by definition imperfect because no two companies are exactly the same, and groups of companies are hard to bucket. But it's just a way of trying to make sense of thousands of stocks. So having, to answer your question in particular, yeah, if you're looking outside of like healthcare, like the XLV or the pure biotech ETFs like the IBB or something like XBI, I would be looking at something that's more of like a broad technology-oriented thing. The Qs might be the best example of where I would do. You can also, if you Google for something like Amgen or BIIB, Biogen, and look for ETFs with a big weighting in those stocks, a lot of times that can show you, there'll be like innovation funds and genomics funds and stuff that will probably come up that you may not be aware of. Just as always, do your due diligence on liquidity and spreads and fees and all of that, because it's tough sometimes to go into ETFs you're not really familiar with. Next question. I enjoyed your ratio discussion. That was Wednesday's show. And thanks so much. I had fun actually putting that one together. Can you please look at the ratio of SPHB to MTUM on the daily and the weekly? Would Edwards and McGee say that's an inverted head and shoulders breakout? And what would that mean in macro terms? That is a very awesome, nuanced question. And I'm going to hit it here right now. So you're talking about two. The SPHB is the high beta ETF, and MTUM is the momentum factor. So so there are so many things you just hit on here. Number one, MTUM, a lot of people think of that as a growth ETF, and it really isn't. If you look at the MTUM, the momentum ETF, that is meant to be in stocks that are leading. That's in stocks that have had good trends, and it plays into them. So at times, MTUM looks a lot like technology, XLK, basically. It'll be very similar. But right now, if you look at the biggest weightings, I haven't looked at them, but I guess it's a lot of energy. It's big banks because those are the things that have been working. So it's not a technology thing, and it's not a growth fund. Momentum doesn't mean growth. It means price strength. So when value is working, the momentum fund actually looks a lot more like a value-oriented fund. It's going to look more like energy and financials right now. But that's the idea. That's sort of the idea of trend following. You rotate into what's working. So on the daily, what I'll do is do like a 2-year chart of this, and we'll see what we can say of it. So is this a big head and shoulders time? I'm not sure exactly what you're talking about, but maybe you're talking about this big kind of head and shoulders ish thing. So would Edwards and McGee call it that? So the answer is no, they wouldn't at all. Only because if you look at that, book, early discussions about head and shoulders patterns, volume was a very important piece. That Tom McClellan always hounds me on that. When he catches me talking about head and shoulders patterns and I'm not showing volume, he's saying, nope, without volume, it is not a head and shoulders pattern. Because early guys like Edwards and McGee that did it, volume and thinking about the volume characteristics would tell you whether or not it was a valid head and shoulders pattern. So I am not seeing a head and shoulders pattern on that. I would be thinking about whether it's in an uptrend or downtrend, and I certainly am seeing it in an uptrend right now of higher highs and higher lows. So for me, I think that's totally valid. Great question. That was a lot of different things to pick apart there. Let's see. Interesting action in the markets this week, especially the bond market. My question is, how do you monitor the individual components of the bond yield curve intraday? And another question, how do you chart the 10 and 20 and 30 yield curve on an intraday basis? So obviously a lot of movement, and I know a lot of people are sort of asking questions about that. So here's what I would suggest. If you go to Charts and Tools and go to the market summary page and go to table view, go down here to where we have the bond listings, US bonds, sorted by symbol. That might be the easiest way to do it. So we have two sets of things on here. The official stuff we get from the US Treasury all start with $UST something. And these are updated end of day. So these don't refresh during the trading day, but the end of every day will update with the current reading. The CBOE publishes real-time interest rates. So you have short-term, that's the shortest end of the yield curve, the 5-year note, the 10-year note, the 30-year bond. Those are the ones that update during the year. So I would create an ACP list and have these 4 tickers on there. You're going to get a real-time view of the yield curve. We don't have something that shows the shape of the yield curve during the day. That might be something I throw at our developers at some point, but we do have this dynamic yield curve, which uses those end of day points. That's actually a fascinating thing to look at, especially now where we're talking about the the S&P and what happens when a yield curve is inverted. How do you think about steepening and flattening curves? It's just a beautiful visualization. So simple but so powerful. That's all the time we have for the Final Bar mailbag. Thank you all so much. Those are some really good questions. I appreciate you sending them to us. And as always, good to hear from you. We need to wrap the show and wrap this week. The 3 and 3 charts in 3 minutes. Here we go. Chart number 1 comes from my friend David Linton. David runs a firm called Updata. I've known him for a number of years, and he shared a chart similar to this. I replicated sort of the essence of what he's done. This is my version of looking at basically the yield in stocks versus the yield in bonds. At the top, you have the spread, the yield, the dividend yield on the S&P minus the yield on the 10-year Treasury bond. So when this is at 0, which it just hit this week for the first time since mid-2019, that tells you that basically you get the same yield by owning the S&P versus owning the 10-year Treasury yield. That has been favoring stocks for a while on a yield basis because the S&P was yielding a lot more, and 10-year yield was essentially 0, really close, very, very low. With the increase in yield that we've had in the last couple of months and the decrease in yield on the S&P because of the rising prices and dividends flat to down, you now have an even, basically you're at a wash whether you buy treasuries or stocks on a yield basis, which is an interesting thinker, right? A chase for yield. You actually can get it from bonds here. Chart number 2 is iBuy. That's the online retail ETF. There are a couple of e-commerce ETFs that I've followed for a while. I'm always thinking about one chart to pay attention to. This might be one. I was thinking about the speculation that we've seen in a lot of these e-commerce sort of new economy names, clean energy names, etc. A chart like this holding its 50-day, which happens to be right by the January lows, I would be a believer in a return to a bull market phase and this being a buyable dip. If we break down through the 50-day, we break down through that January low, the RSI goes below 40, which I certainly think is a legitimate risk in next week and beyond. I think you will see a flight to the exits that we haven't seen in quite a while. We break support when institutions see that these stocks are not going to be a buyable pullback anymore and that you need to more, manage your downside risk. I think you can see things accelerate to the downside as some funds with big holdings in there would get significant outflows potentially. Third, gold and silver. The XAU was down almost 5% today, bounced a little bit going into the close, but have been struggling. Gold prices going down. This is sort of the traditional inflation hedge that you would expect as gold prices going up. We haven't seen it yet. So I think gold has a little bit further to go, and gold around 1,700, I think, is an interesting downside target. When you look at the XAU, we're right by that Fibonacci support level, the 38.2% level, which is not far from the lows we had last November. We're sort of right there with the January low, with the November low. Interesting to see if this is able to hold. If it breaks, I think you have to look at some downside risk along with other charts as well. Folks, that is our show and a wrap for this week on the Final Bar. Thank you so much for joining us every weekday after the close for our show. Check out the new Stock Charts TV on demand. Go to stockchartstv.com. We're also on all the app stores. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.